Hare Krishna. Welcome to Tax YouTube channel. This is C. Rohan Arping, a practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to the video series Concurrent Audit of Bank Branches. And today we are going to conduct session 7. So let's dive into it. Let me allow to share my screen. Yes. And so today we are going to discuss KYC, AML, and CFT compliance. In our previous session, we discussed audit of deposit accounts. However, deposit accounts are only as reliable as the identity and integrity of the customers behind them. So therefore, today's session moves into one of the most critical compliance areas in bank audits. That is what? KYC, AML, and CFT compliance. So KYC is not just documentation. It is the foundation of the banking system integrity. AML and CFT frameworks are designed to prevent the misuse of the financial system for money laundering, terrorist financing, and other financial crimes. For concurrent auditors, this area is what extremely sensitive because non-compliance may attract penalties from the Reserve Bank of India. Banks face regulatory inspection observations. Branch officials may face accountability proceedings, and STR failures may attract serious enforcement consequences. So today we will cover this topic deeply and practically from the perspective of the branch audit. So moving further, let's understand legal and regulatory framework. The KYC and AML framework in India is governed primarily by the Prevention of Money Laundering Act 2002, that is PMA-LA, rules framed thereunder PML Rules 2005, RBI's Master Direction on KYC, reporting requirements to Financial Intelligence Unit India, India's commitments to global AML standards issued by Action Task Force. So concurrent auditors must remember KYC compliance is not optional. It is what? Mandatory and statutory. Let's moving further. Let's see KYC master directions overview. So the RBI has issued the master direction, know your customer, that is KYC, to standardize the compliance across the banks. Key elements includes what? Customer acceptance policy, customer identification procedures, risk management, and monitoring of the transactions. So directions mandates a risk-based approach, that is RBA, we can call it as, meaning higher scrutiny for high risk customers. Higher scrutiny for high risk customers. So as a concurrent auditors, we need to verify whether branch follows the documented KYC policy of the bank, whether periodic updates are being complied with, whether risk categorization is documented or not. So moving further, let's see customer acceptance policy, called it as CAP. So under CAP, no account should be opened in fictitious names. No account should be opened without proper CDD. High risk categories must be escalated. So audit focus should be randomly check new accounts open, verify PAN, Aadhaar, OED, and ensure what? Ensure no incomplete documentation. Means documentation should be there. That is complete documentation should be there. Aadhaar card, PAN card, other verification document. So moving further, let's see customer due diligence concept. What is it? So that is CDD includes, that is customer due diligence includes identifying the customer, verifying the identity using reliable sources, identifying the beneficial owner, that is also called as BO, understanding purpose of the account, very important, and ongoing monitoring of the account. So concurrent auditors must examine whether beneficial ownership declaration is obtained, whether partnership or company documents are complete, and whether customer due diligence checklist is signed and verified. Let's understand beneficial ownership. What is it? Beneficial owner refers to the natural person who ultimately owns or controls the entity. Audit check should be whether shareholding pattern examined, whether BO declaration obtained, and whether high shareholding individuals are verified. So there can be a red flag would be shale companies with complex layering. That would be the red flag in this case. Moving further, let's understand periodic updation of KYC. So periodic updation frequency in case of high risk category accounts every 2 years, medium risk category accounts every 8 years, and low risk category classification accounts always after 10 years. So check system generated due reports related to this, whether overdue KYC cases exist. If exist, then discuss with the branch manager whether transactions allowed in KYC overdue accounts, very important, whether any transaction taken place in the KYC overdue accounts. Okay. Moving further, let's understand enhanced due diligence, that is EDD, we can call it as. So EDD applies where risk is elevated. That is examples, PEPs, that is domestic and foreign non-resident customers, high cash turnover accounts, NGO accounts. So audit procedures will include verify the PEP declaration, check approval from the senior management, and review the source of funds documentation. Very important. Moving further, let's understand politically exposed persons, that is PEP. It includes senior politicians, bureaucrats, judges, military officers. So audit checks here would be whether this PEP tagging done in CBS, whether senior approval documented, and whether transactions are monitored. So failure in PEP's due diligence is a serious regulatory observation as a concurrent auditor. Let's understand high risk customers and accounts. So risk categorization depends upon nature of business, geography, mode of the transactions, and customer profile. So audit include verify whether the risk classification is logical, whether it is correctly classified, that is a high, medium, low. Reclassify if required based on the activity carried out by the customer. Let's see examples of high risk accounts. So high risk indicators what? Sudden spike in transaction, cash deposit inconsistent with the profile, layered transfers. So concurrent auditor must perform what? Analytical review and examine unusual patterns. So these are the examples of high risk, that is trust, NGOs, cash intensive businesses, NBFC accounts, dormant accounts reactivated, multiple accounts with same introducer. So we need to take care of this. Moving further, let's understand STR CTR reporting, that is auditor's role. First, understand CTR reporting. So this is cash transaction report. CTR stands for cash transaction report. So cash transactions above prescribed limit, aggregated per customer per month, submitted to the Financial Intelligence Unit India. So auditor role here will be verify the system generated CTR, ensure no manual suppression, and check the branch awareness related to this. Under STR reporting, that is stands for suspicious transaction report, no minimum threshold based on suspicion must be filed promptly. Auditor rules here is review unusual transaction, check whether branch escalated suspicious cases, and verify the internal reporting mechanism. What is important here is the auditor should not disclose STR filing to the customer. Let's see common KYC irregularities and reporting thereof. Common observations in concurrent audit: accounts opened with temporary documents, KYC pending but transactions allowed, no periodic update, inadequate address proof, very important and very common KYC disqualification, inadequate address proof, signature mismatch not verified. This must be reported in concurrent audit report if there are lapses related to the KYC. So escalated in serious cases and follow up for rectification. We need to also take a follow up after the our pointing out the query. So moving further, let's see auditors reporting format under this. So reporting must include number of accounts with deficient KYC, number of KYC overdue cases, high risk accounts not tagged, cases requiring STR review. If serious systematic issues observed, escalate to the regional or your zonal office and statutory auditors if material. Let's see practical audit checklist for the concurrent auditor. So practical audit approach includes select 20 to 30 new accounts, review the KYC overdue MIS, check 5 high cash transactions or high cash accounts, examine 2 NGO or trust accounts, review internal suspicious reporting mechanism. So document findings are very need to be properly done. Moving further, let's understand regulatory consequences of non-compliance. So non-compliance consequences related to this KYC and all this stuff are monetary penalties by Reserve Bank of India, adverse inspection remarks, risk of frauds, legal proceedings under PMLA. So auditors' vigilance protects the bank and the financial system. So now, what we can conclude from the today's session is KYC is not a clerical documentation. It is a national financial security framework. It is a first line of defense, we can say it as. As a concurrent auditors, we must verify the documentation, assess the risk categorization, evaluate the transaction monitoring, identify the suspicious patterns, and strong KYC compliance prevents what? Money laundering, terror financing, and fraudulent activities. So let us discharge our professional responsibility with a due diligence and skepticism. So that is, I can say is that the KYC related anything is like a first line of defense. It is equal to first line of defense. So that must be taken care of. So that's it for today. Please note down my contact numbers. If you have any questions, query, observations, suggestions, then do let me know via WhatsApp or via email, or you can also comment below the video. Hope you are gaining the valuable knowledge from all these video series. Okay, if you are not yet subscribed, Tax YouTube channel, then do subscribe for latest updates and video series like this. So thank you so much once again. Bye bye. Take care. See you soon. Hare Krishna.